We're taking a look at the currency market now with Adriaan du Toit, Macroeconomic Strategist at Standard Bank. Good morning, Adriaan. Thanks so much for joining us today. Well, we saw the rand weaken against the dollar yesterday as the Greek plan for a referendum really spooked the markets. To what extent have you resided yourself in the fact that this is something we're simply going to have to wait and see itself play itself out, that volatility is going to be the name of the game for the longest while yet?
Well, I think that's exactly right. I think we're going to have an extended period of uncertainty. The first vote coming up at the end of this week, and leading up to that, it's very unlikely that you'll have risk appetite increasing substantially from current levels. It does seem to us that, again, as has been the case previously, it's this political brinkmanship that is really the biggest or highest hurdle for the global economy to gain any traction. And this leads to a lot of fear and uncertainty. And on the back of that, emerging market currencies, and especially liquid currencies like the rand, keeps getting under the hammer. We expect that the rand will remain relatively weak, and a range for the Q4 is really about 780 to 820. But considering the amount of event risks that we've got this week, including the FOMC, the ECB interest rate decision, and obviously the vote, something north of 8 seems much more reasonable in the very short term.
Of course, we're so concentrated on the risk emanating out of the Eurozone. To what extent are we underestimating the risk that possibly resides itself in the East? I mean, we had global data showing yesterday that China's factory activity in October was at its slowest pace since February 2009, and that would weigh because we have South Africa, a major exporter of raw materials to China.
Absolutely. I think it also highlights the point that there's really no support for a decoupling thesis that Asian economies will continue to push the global economy ahead despite the fragility that we've seen in the US and Eurozone economies. I think what we've seen is over the last few months, we've entered a soft patch, and we're a bit in limbo at this stage where we don't know where we're going from here, and not managing to gain enough traction, as I said, to get out of this soft patch, and stall speeds and things like that come to mind more often now, and especially when you see Chinese PMI not really pointing to a significant increase, and what you see in the UK and Eurozone, their respective manufacturing indices pointing to a very similar position, suggesting that it's going to be a tough battle going forward, and it's going to take a bit more than a few votes to correct the situation that we're faced with.
Very interesting is that we continue to see local data pretty much ignored by the markets. We had PMI numbers come through locally as well yesterday, and that unemployment number too, but reaction towards that very muted within what is playing out on the global scene.
Well, I think that's probably right, considering the magnitude of the wave that's coming from abroad. The domestic data releases, not terrible, but if you really look deeper into it, it's also not that encouraging. The PMI is around that 50 handle, so it suggests that manufacturing is at least not contracting, but looking into the prices component, for example, it suggests that prices could again continue to rise. That's that price at the factory gate, and that could very easily spill over into consumer price inflation in the next few months. And when you look at unemployment figures, yes, we've created jobs of about 190,000 quarter on quarter, but there's some anomalies, not anomalies in the sense that they errors from statistics, but they do point out, for example, that you've got in the mining sector where you had an increase of 40,000 jobs. They do have a footnote saying that these estimates are not particularly robust, and that implies that then your aggregate increase of 190,000 is maybe not that robust as would seem to be the case at face value.
You touched on the FOMC meeting in focus today. Let's take a look at what you're expecting there, because hints of further easing would certainly weigh on the dollar, and it would then lift the yen, of course, at a time where we saw Japanese authorities intervene in the markets, vowing to take any action to quell that kind of strength.
That's absolutely right. I don't think we're going to see any change from the FOMC meeting today. What we could very well, however, see is that they start providing or doing the groundwork for potential further accommodation, whether it be via QE3, in whichever form. You could find that the rhetoric moves more in that direction, and that is a negative for in the short term. That could still be very positive for the dollar, considering the relative distress that we've seen in the euro region, and an acknowledgement from the the FOMC or the Fed specifically, that things aren't gathering pace as they were hoped before, could again put risk of more fears into the market, and again we see risk aversion, and unfortunately or fortunately, depending on where you're positioned, it could again benefit assets like US Treasuries and the dollar.